The Medallion fund is the most famous fund on Wall Street. They made 62% return per year over the last 30 years. Putting that into perspective, the S&P 500 made 8%. So what does Medallion do? I'm going to show you in this video. So there are two main strategies funds like Medallion use to make money. The first one is trading based on information asymmetries, and the second one is trading based on statistical arbitrages. So let's start with information asymmetries. I told you that the price of an asset is formed by what people expect this asset to pay and what the risk profile of that asset is in the future. The thing now is, if you have better information than everybody else, if there is an information asymmetry between you and everybody else, then you can trade on that and you can actually make money. Let me show you how. You're in 2019 and there's the stock of a small biotech company. And the stock, it's trading at about 25 to 50 euros. And then of course in late 2019, COVID-19 happens. And this biotech company realizes we could actually have a shot at making a vaccine against this virus. And the end of the story is the company is called BioNTech. They're the first one to develop a COVID-19 vaccine, and the stock price goes to the roof. So if you had known that in 2019, you could have bought the stock in 2019, sold it in 2022, and be incredibly rich. The point, of course, is that no one knew in 2019. No one knew that COVID was going to happen. BioNTech itself, they thought they were doing cancer research, so they didn't even know themselves. And that is, of course, why the price of BioNTech was so low, because in 2019, no one thought that they would be the ones making the vaccine against COVID. So the only way to make money this way is to have a constantly better prediction than the market, to be constantly better than the guys from Goldman Sachs, JP Morgan, and Bank of America. And that very seldomly happens. But from time to time, people come up with ideas to make predictions better than the market. Example number one, the Walmart trade. One thing that often moves stock prices is the earnings announcement of a company. Big companies have to announce their earnings every 3 months, and that is kind of a moment of truth, because the earnings announcement gives you on paper what the company actually made in profits. Before that, you can only make estimations of what the company is earning in those months, but with the earnings announcement, you have it black and white. And that often moves stock prices because there are expectations out there in the market. There are actually surveys among analysts what they think what the earnings will be for a certain company. So it could be, I don't know, 300 million in revenues, 200 million in revenues. And then you get the earnings announcement, and sometimes that differs. And if that differs, then the company is less valuable or more valuable than expected. And of course, then the stock price has to move. And here you see an example of Walmart. This is in 2021, in February 2021. And the earnings announcement is on the 18th of February. And you see on that day, the stock price drops heavily. Why? Because the earnings were lower than expected. The thing is, if you knew that beforehand, you could make a trade. There are financial products which pay you money if a stock goes down. So you could buy that financial product if you knew that the stock was going to fall and make a lot of money. And here's what people came up with. People started to look at satellite images of Walmart parking lots. And they looked at how many cars arrive at Walmart's parking lots. And with that, they were able to make incredibly good predictions of Walmart's earnings. Why? Because if you know how many cars there are, you know how many customers Walmart has, and you also know how many sales they're going to make. And with that, they could make a trade. They looked at the analyst surveys, and if their estimation of the Walmart revenue was higher, they would buy the stock and sell it after the earnings announcement. And think about it, this is classical information asymmetries. You know better than everybody else what the Walmart revenues are going to be, so you can trade against everybody else to make a profit out of that. Example number two is also about satellite data. People came up with looking at satellite data of ships arriving in ports of a country. And they analyzed how many ships are coming to that country. And they also looked at how heavily loaded ships are by analyzing how the sea levels change in the ports when the ship is coming in. And with that, they could predict how many trades a country is doing. And that would give them an incredibly good prediction of the GDP numbers of a country. And the GDP, of course, when it's announced, influences, for instance, government bonds. So they could make a trade on government bonds based on their prediction of what the GDP of that country is going to be. But the thing is, with the satellite data approach, Now everybody's doing it. JP Morgan has their guys, Goldman Sachs, they also have their guys looking at satellite data. So now you can't make better predictions than the market based on satellite data, because the satellite data is already in the price. Your prediction based on satellite data of the Walmart revenues will be 100 million, but that will be everybody else's prediction as well. So the information asymmetry is gone. You have the same information as everybody else because everybody is using satellite data. So the satellite trading strategies, they don't work anymore. A third example, which I love, is from London. Guys in London started to analyze the sewage system for bacteria in autumn of every year. And with that, they were able to predict how heavy the flu season is going to be and how much pharmaceuticals people will buy. And with that, they of course could trade with pharmaceutical companies. If the flu season is going to be very strong, they would buy pharmaceutical companies, the companies would make a lot of sales, rise in stock value, and then they could sell the stocks again. So you see, if you want to create an information asymmetry, you need to be extremely creative. You need to be more creative than everybody else in the market. Otherwise, it's not going to work. And of course, all the strategies I've just told you, they leaked. People know what they are. I mean, I'm telling you them on YouTube, so they won't work anymore. But you can be sure people in funds have their new strategies, which are not leaked and which still work. The second approach Medallion is using is called statistical arbitrage. And this is really where Medallion has, I think, their competitive advantage. Statistical arbitrage is actually super boring. Medallion just builds computer algorithms which look at patterns in data. And these patterns can be completely arbitrary. It could be the day after the Amazon stock falls, the Tesla stock is rising. Why? They have no idea themselves. They just observe that pattern and then they trade on it. So if they see Amazon falling, they buy the Tesla stock. The day after, the Tesla stock is rising and they sell it again. And it could be that after some time, this pattern just does not emerge anymore. And then they stop doing that trade. But Medallion has probably 1,000 of those little patterns that they use at every moment in time. And if one pattern goes away, they find another to exploit. So now you could ask, if they're so good at finding these patterns, why isn't everybody giving them their money? And the reason is that those strategies don't work at scale. Remember our supply and demand diagram. And let's say, for instance, they've observed the pattern that the day after the Amazon stock is falling, the Walmart stock is rising from $10 to $15. So what they would do is they observe the Amazon stock falling and then they start buying Walmart stock on the same day. But if you start buying in very large quantities, you start to move the demand. So you would buy the first Walmart stocks at $10, but because you create so much demand, the price is rising, so you start buying them at $11, $12, $13, $14, and $15. So you have moved the price from $10 to $15 yourself. And then on the day after, the Walmart stock can't rise from 10 to 15 because the price of the Walmart stock is already at 15. You've moved it yourself, so your strategy doesn't work anymore. You have destroyed your own strategy by creating that much demand. And this is the reason that you can't invest into the Medallion Fund. The Medallion Fund only uses money of its own people because they have to restrict the amount of money they do their trades with. Their strategies don't work at scale. So wrapping this video up, Medallion has basically two strategies. They exploit information asymmetries and they find statistical arbitrages which they trade on. And people like the guys from Medallion Fund. They are the reason that the market price is such a good predictor of future outcomes, because every information you can think of, satellite data, sewage systems data, it's all part of the price because people trade on it. So those people, I mean, they make a lot of money, but they're also the reason that the financial market works extremely well. And they're also the reason that when you buy a stock, you can be sure, at least most of the time, that the price of that stock is kind of reflecting what its future risk and what its future return is going to be. And this hopefully gives you an idea how powerful this system of a financial market is that we have created as human beings. And in the next two videos, I want to make two essays how we can use this incredibly powerful tool, the financial market, to solve our most pressing challenges. We're going to talk about sustainable finance, so how we can tackle climate change by using financial markets, and we're going to talk about the housing market, how we can fix the housing situation by thinking about housing as a financial asset. So see you in the next videos.